If you've spent any time in the dividend investing space, you've probably heard the term dividend snowball thrown around a lot. And there's a good reason for that. Because once you actually see how it works, it changes the way you think about investing completely. The basic idea is simple. Have you ever watched a snowball roll down a hill? It starts small, but as it picks up speed, it gathers more snow, gets heavier, rolls faster, and by the time it reaches the bottom, it is so much bigger than when it was at the top. In investing, you purchase a dividend-paying stock or ETF. You take those dividends and reinvest them to buy more shares. Those shares pay you more dividends. You reinvest those too, and over time the whole thing starts to feed itself. Slowly at first, then faster and faster. Just like a snowball rolling downhill. Today I will illustrate how this concept works using SCHD, one of the most popular dividend ETFs out there. We're going to run through several scenarios so you can see exactly what the snowball effect looks like over time. SCHD tracks an index of high-quality U.S. dividend-paying stocks, weighted toward companies with strong fundamentals. Things like consistent dividend history, healthy cash flow, and solid return on equity. It's not chasing the highest yield in the market. What it's doing instead is targeting companies that can sustain and grow their dividends over time, which is exactly the characteristic you want at the center of a snowball strategy. Since its launch in 2011, SCHD has delivered an annualized total return of around 13%. It currently yields 3.4%, and it has grown its dividend at 10.6% per year historically. That combination of a meaningful starting yield and strong dividend growth is what makes SCHD such a clean example for this kind of illustration. We're going to model 3 scenarios, each starting with a $10,000 lump sum investment, adding $500 of contributions each month, and reinvesting all dividends. We will track performance across 10, 20, and 30-year horizons. You will be amazed to see what this relatively small investment can do for your financial future over time. Please remember, this is not investment advice. Always do your own research before making any financial decisions. Let's start with the simplest version of the snowball. You invest $10,000 in SCHD today. You switch on dividend reinvestment, and you don't add anything else. No monthly contributions, no topping up, just the initial investment doing its thing. After 10 years, your $10,000 has grown to $33,946. You haven't added a single dollar, but your money has more than tripled. That's already a result most people would be very happy with from a one-time investment. At 20 years, the compounding really starts to show. That same $10,000 has become $115,231. And at 30 years, it reaches $391,159, nearly $400,000 from a single investment that you never touched. What makes this a snowball rather than just straightforward growth is what's happening to your dividend income along the way. By year 30, your portfolio is generating around $13,300 in annual dividends. That's $3,300 more than your original investment of $10,000. Each year, the dividends buy more shares. Those shares generate more dividends, and the cycle repeats at a slightly larger scale every single time. Now let's look at what happens when you interrupt that cycle. Same $10,000 starting investment, same SCHD, but instead of reinvesting the dividends, you take them as cash every time they're paid. After 10 years, your portfolio has grown to $25,010 through price appreciation, and you've collected $5,577 in dividends along the way. Combined, that gives you $30,587, already about $3,000 less than scenario 1, from the exact same starting point. At 20 years, the gap widens. Your portfolio sits at $62,548, You've taken $20,851 in cash dividends, and your combined figure is $83,399. Scenario 1 delivered $115,231. That's a difference of over $31,000, purely from the dividend reinvestment. At 30 years, the divergence is hard to ignore. Scenario 2 gives you a portfolio worth $156,429 plus $62,684 in dividends you've spent, a combined $219,112. Scenario 1, $391,159. The gap is over $170,000. This isn't to say that taking dividend income is wrong. For investors who are retired or approaching retirement and need that cash flow, it makes complete sense. But if you're still in the building phase, it's worth remembering that every dividend you take as cash today is a dividend that never gets reinvested, never buys more shares, and never contributes to the compounding cycle. The snowball only grows if you keep feeding it. This is where the concept really comes to life. Same $10,000 lump sum with dividends reinvested, but you also add $500 every single month in contributions. I have used $500 a month in my example, but you can use any other amount. I understand that for some people $500 is a lot of money to invest, while others can invest much more. The more money you can contribute each month, the faster the snowball compounds. After 10 years, your portfolio is worth $150,904. You've put in $10,000 up front and $60,000 in monthly contributions, $70,000 of your own money in total, and compounding has turned that into over $150,000. More than double of your invested capital. At 20 years, the number starts to feel hard to believe. $629,212. You've contributed $130,000 of your own money over that time. The rest, nearly $500,000, has come from compounding, reinvested dividends, and market growth. And at 30 years, the portfolio reaches $2,252,861. Over $2 million. By that point, it's generating around $76,600 per year in dividend income alone, more than many people earn from a full-time job, from an investment that started with $10,000 and $500 a month. That is the dividend snowball at full speed. The monthly contributions keep feeding it. The reinvested dividends pack it tighter, and time is the hill it rolls down. Looking across all three scenarios, the message is clear. Reinvesting your dividends makes a significant difference. Adding regular contributions makes an even bigger one. And time is the most powerful variable of all, something no amount of money can replace, which is why starting early matters so much more than most people realize. The figures in this video are based on SCHD's historical performance. A 13% annualized total return, a 3.4% yield, and 10.6% annual dividend growth. Past performance doesn't guarantee future results, and no investment is without risk. But the underlying principle holds regardless of what the market does in any given year. Consistent investing, dividend reinvestment, and patience are the three ingredients that build the snowball. The investors who build real wealth from dividends are rarely the ones who found a perfect stock at the perfect time. They are the ones who understood the mechanics, started early, and kept going. If today's video has given you a clearer picture of how the dividend snowball works and what it could do for your own financial future, then the next step is simply to start. I wish you best of luck. Thank you for watching until the end. I hope you have enjoyed the video. If you have any questions, please put them in the comments section and I will do my best to answer them. See you next time.